Hello, my friend. Welcome to Charley Retail Invest. Let's track the latest trend in US economy and share our in-depth analysis and recent investment in stocks and bonds. As we discussed in our video on October 23rd, we've purchased a total of 210 shares of Tesla stocks between October 16 to 18, with an average cost of $220 per share. Back then, Tesla stock tanked by 10% on October 10th after the market got skeptical about its timeline of its robotaxi development. In the press release, Tesla expected robotaxi, the fully automated car taxi service, could be readily available for the market by 2027. However, investors thought that 2027 was way too good to be true, given the numerous regulations that need to be met before Tesla's robotaxi service can be allowed to enter the market. So we bought Tesla stocks after its price dropped from $240 to around $218 about 10 days ago, and planned to sell them after its Q3 earnings call on October 23rd for short-term capital gain. We bet on this trade because we believe that even though Tesla's car sales number may not look particularly impressive for Q3 this year, Wall Street still has plenty of good reasons to pump up Tesla stocks, given that it's the leading company in AI automation, electric cars, and renewable energy sectors. Lucky enough, the second day after Tesla released its third quarter financial report, its shares soared by a whopping 21% in a single day and reached over $260 by the end of October 24th. And our position also had a net gain of over 13%. Thanks to this surge in Tesla stock price. In order to play it safe, we sold all our position in Tesla by $250 per share and secured a net profit of over $6,000 in about a week's time. As a short-term trade, our performance is quite impressive. If you followed our videos, you might know that back in September of this year, we did also buy Tesla on August 30th. With a price tag of around $210 per share back then. We held these Tesla stocks for less than 3 weeks and sold all of them on September 18th to get a net profit of 9%. We think that Tesla stock has been pumping up and down for the past 3 years, and this kind of pattern is very suitable for traders to do short-term trades, quick in and quick out. And we don't need to worry about getting underwater for a long time, because every time Tesla stock goes down, it always bounces back shortly. Unlike many small and medium-sized companies, Tesla is one of the Magnificent Seven companies, the leading company in AI technology and electric cars. And its CEO, Elon Musk, has huge potential in social media and around the world. So Wall Street can always find good reasons to pump up Tesla's stock price whenever they need. Let's look at Tesla's stock price history for the past 5 years. We can see that after its net revenue turned from negative to positive, Tesla's stock price has always been in the range of $200 to $400 per share, generally speaking. And now the price to earnings ratio, or PE, is still quite high at about 70. However, if we compare the PE ratio of Tesla to NVIDIA, we can see that NVIDIA's PE ratio has also increased to 66, which is basically at the same level as Tesla. Moreover, Tesla's market cap is only $820 billion, whereas NVIDIA's market cap is at $3.4 trillion, about 4 times bigger of its size compared to Tesla. In other words, if Wall Street wants to pump up a company's stock price, it's much harder to pump up NVIDIA stocks than Tesla's, because it would require at least 3 to 4 times more capital to have the same effect for NVIDIA stock price compared to Tesla. So as retail investors, we should be very careful that NVIDIA's current price level has more risk of going down significantly compared to Tesla. Now, the Wall Street is super bullish on Tesla's business in self-driving program FSD, robotaxi service, as well as its solar energy outlook. In addition, the manufacturing numbers of Cybertrucks in North America and China markets have also been kept rising, and more deliveries of this new model will lead to higher earnings in Q4 of 2024 and early 2025. Therefore, many analysts have raised up the target price of Tesla stock, and more people tend to believe that it will go above $300 per share by the end of this year. Some enthusiasts even say that Tesla stock will go above $1,000 in 6 months, which goes a bit too far. Nonetheless, I'm still quite bullish on Tesla's performance over the next 2 months. This is also due to the fact that its founder and CEO, Elon Musk, has been a major supporter for GOP candidate Trump for the past several months. Apart from large donations to his campaign, Musk has said that he may be playing an advisory role in Trump's administration if he gets elected as the US president. As we are just 1 week away from the presidential election on November 5th, the likelihood that Trump wins over Harris is getting bigger and bigger. And the investors now believe that after Trump becomes the president, new policies will come out that benefit energy-related companies like Tesla, which is another key reason that Tesla stock has been pumped up recently. So the thinking behind me selling Tesla stocks last week is to use the money to buy stock index ETFs like QQQ and VOO when their prices get lower. From a long-term perspective, it's much safer to hold stock index compared to holding Tesla stocks. Of course, if there's more volatility coming in 2025 and Tesla stock price drops to a lower level, we will buy at a dip and seek for short-term capital gain, like what we did back in September and October of this year. If you don't want to miss our trading activities, please click the subscribe button and you will receive the latest information. Also, feel free to leave your thoughts on Tesla stocks in the comment section below. After selling Tesla stocks, I bought a total of 100 shares of Google's parent company, Alphabet stocks, at a unit price of $165 per share. We know that Alphabet will have its Q3 earnings report published tomorrow on October 29th. Market now expects that Google's revenue in Q3 of 2024 will be at $86.4 billion, which is 12.6% higher than Q3 of 2023. So it's likely that Google stock will have a decent jump after the earnings call, and I bought some before that as long-term investment. I'm quite bullish on Google's performance in the next year. As you can see, among the Magnificent Seven companies, Google has the lowest PE ratio at 23. As a comparison, other tech giants like Amazon, Microsoft, and Apple, all of which are very well established in their main businesses, all have much higher PE ratio at 35 or even 40. So Google is relatively much cheaper compared to other Magnificent Seven companies, and it's a great choice to buy and hold as long-term holdings. There is an institutional investment group that published a paper in Forbes, and they claim that Alphabet stock has the potential to triple in price and get over $500 per share in the coming years. From their perspective, Alphabet might replace Apple and Nvidia and become the largest company in the world. Moreover, the increase in revenue will not come from Google's search and advertisement businesses, but from Waymo self-driving service. Recent data has shown that the weekly rise of Waymo self-driving car have increased from 10,000 in 2023 to over 100,000 in 2024. And the paid rides per week have also jumped from 50,000 back in April of this year to 100,000 in October. So the growth of Waymo rides has been very impressive. In the future, if Waymo rides can reach just half of Uber rides, which is over 200 million rides per week, then Waymo's business will bring over $300 billion of additional revenue to Alphabet. Of course, I think this estimate is over-optimistic. However, it's quite clear that Waymo has becoming a leading force in self-driving and AI, and it might have the potential to catch up with Tesla in this field, although it still has a very long way to go. At the same time, this paper also indicates that if Alphabet wants to have its stock continue the upward trend in the future, it must find new growth opportunities, including self-driving vehicles or some other applications where AI can become the dominant player. And the Wall Street will not reward much for its main business in Google search and ads in the future, as they are reaching a peak level that doesn't have much room of growth in terms of revenue. Actually, I have several friends who work as software engineers in Google, and most of them are not very happy with how its CEO, Sundar Pichai, has led the company for the past several years. This is because Google has missed several great opportunities to become the leader in AI, especially in large language model or LLM area. They are behind Microsoft and OpenAI in terms of the market cap for those emerging services. If Google's stock performance remains lackadaisical for the next 1 to 2 years, the Wall Street may force Google's board to replace Pichai with a new CEO. And a positive example is Microsoft and Nadella, who became Microsoft's CEO back in early 2014 to replace Steve Ballmer back then. Nadella has been very successful in leading the transition of Microsoft from being the dominant player in PC and Windows to become the leader in artificial intelligence. Now, Microsoft's market value has exceeded $3 trillion and become the third largest public company in the world. Google has also been playing catch-up games recently in order to narrow the gap between them and Microsoft. Pichai recently revealed that apart from the great earnings from Search and Google Cloud, they have also doubled down the investment in AI. And Google's Gemini chatbot model has developed logistics abilities that's similar to a human being in the recent month. If you are interested, I will bring more updates on what happens in Silicon Valley and the tech industry. But from the current market, we can see the Magnificent Seven are still the leading force in the US stock market to push new all-time highs in late 2024. Artificial intelligence is also the main driver behind all this momentum, and it might last much longer than one would expect. We will keep monitoring its progress and update you with the latest news. Another stock that I have bought in a large chunk is Lockheed Martin, or LMT. For the past 2 weeks, I've bought a total of 70 LMT stocks with an average cost of $566 per share. In our video on October 23rd, I've mentioned that LMT's price has tanked by over 8% after its Q3 earnings because its revenue slipped a bit below Wall Street expectations. Another key reason that LMT's stock price keeps falling recently is that Israel is quite dovish when attacking Iran, which means that the war in the Middle East will not escalate, which is inherently bad for defense stocks like LMT. However, I believe LMT is a great company to invest as long-term securities, with its PE ratio at only 20.2. If we look at the world, we can see regional conflicts and tensions have been very high, as the Ukraine and Russian war, the Middle East conflict, and China and Taiwan's tension are still continuing. Thus, the need for more warfare weapons and fighter jets will likely increase in the coming years. Additionally, LMT pays a dividend at 2.4% annually, which makes it very suitable to buy the dip and hold for long term. So that's the whole story of today's video. If you are a retail investor like myself and would like to know more about the US economy updates and our most recent trading activities, please give us a thumb up, share this video, and consider subscribing our channel, Charley Retail Invest. We really appreciate your support. You are also more than welcome to leave your thoughts on the stock market and US economy in the comment section below. Thank you so much for your time, and I will see you in the next video. Please take care.